So what are central banks doing with their money? You know, it's always good to check in on what the big money is up to. Let's get the details. We have Douglas Borthwick. He is a managing director of Faros Trading. Also with me, we have Larry Swedroe of Buckingham Asset Management, where he helps oversee $3.5 billion worth of client assets. And he's also the author of the new book, Investment Mistakes Even Smart Investors Make and How to Avoid Them. And we have Michael Purves. He is the chief market strategist of BGC Financial. Douglas Borthwick, the idea that central banks are buying euros against the dollar, is that a trend that you see continuing in 2012?
I do see it continuing in 2012. You know, they're short the euro right now, and they're very long dollars. You know, the latest estimates have now put China's reserves at 75% of dollars, and you know, they want to diversify out of that. They see it as a prudent investment to get out of it. And the euro, where it's trading right now, I think they see value in that. Now, the Middle East has certainly been buying aggressively over the last few days, and we've been seeing them in size coming in. Asia
buying euros aggressively.
Buying euros aggressively, yeah. And Asia continues to work bids very quietly and very slowly.
Why do they do this? Why are they buying the euro aggressively? I mean, don't they think that the eurozone is going to have some kind of debacle?
Well, I don't think everyone believes that the eurozone is going to have a debacle. I think it makes for a great story, and fear sells. But I think that most people, including most of Europe, believes that Europe will survive out of this and move forward.
Larry Swedroe, come in on the topic of the euro, because I want to understand the influence that Europe and euro movements have on U.S. investors, because there seemed to be a correlation that worked until it didn't work.
Right. Well, I would suggest you should ignore the noise, as you probably know from our long experience. You know, for every expert who tells you the euro is going to go up for various reasons, and they're going to give you highly intelligent sounding reasons. There are equal experts who are highly intelligent who will give you good reasons it'll go down. I think the best strategy is to have a long-term plan and stick with it. And the reason, part of the reason is when there's bad news, people react, and they think that means bad news means stocks or currencies have to go down. That's what I call stage one thinking, Pimm. What you really want to do is stage two thinking, like there's bad news. Governments and central banks don't sit there and do nothing. As Doug mentioned and you mentioned, now you got central banks not only engaging in monetary easing, now they're supporting their currency. You're finally getting Italy and Greece to take actions to solve budget problems that they never would have taken. The market, in fact, imposes discipline. So you have to learn to do stage two thinking like Warren Buffett does. Instead of panic selling, you keep your head and believe that there will be actions likely to occur. You're not certain, but to counter the problem.
Keep your head. Michael Purves, the idea that there are tactics and there's strategy. Right. But you say with the wolf market, you're not necessarily going to get any clear signals about long-term price movements.
Well, I want to make a distinction here. The wolf market is really a condition for, say, the SPX, for U.S. equities here. And there's a lot of long-term negatives that you know, equity markets have to wrestle through. They've been wrestling through them. They will continue to wrestle them. Eventually,
are they numb to them right now? I mean, because we keep talking about, you know, potential resolution to the European debt crisis, right, with this concern over whether the U.S. economy is really strong or is it really just sort of muddling through. Are people numb to these kinds of news items because they've been hearing about them for so long?
Well, I think there's a lot of sentiment extremism that happens. You know, just look at last year. You know, back in March or April, you might have thought the SPX was going, you know, to 1,500, and then a few months later, the world's coming to an end. The answer is somewhere in between. I think scrolling forwards, I think, you know, here in the U.S., you know, investors have to take consideration that there's a lot of austerity measures, that there's excessive debt, that, you know, housing levels are still at 2002. All those factors are long-term factors. They're not going to go away, and we're not going to go, in my opinion, back to a magical sort of V-shaped recovery like you saw back in the 2001, 2002 time period. It's a different situation, and the Europeans certainly have that in spades as well. You know, they've got. I just think investors have to be very careful about distinguishing between systemic collapse, hence back to my August 10th call, and all the other issues associated with excessive leverage.
Larry, as you described, you know, people react to news and then perhaps they do the wrong thing when it comes to their investments most of the time. All right. But if you take a look at the sentiment right now for bank stocks and housing stocks, you'd be forgiven if you thought that we really hadn't, you know, something bizarre had happened in the last 2 weeks.
Right.
That's
this very typical, though, and it's one of the mistakes I described in my book.
Typical based on what? Based on economic news or just based on?
Yeah. So here's what happens. There's bad news. People then assume bad news means prices have to go lower. That's wrong. The bad news is why the valuations are already low. When you have low valuations, you have high expected returns. Doesn't mean it's a good investment, but it means the expected returns are high. That's when you want to be a buyer if you're going to try to time the market. I wouldn't recommend that. Either does Warren Buffett. But if you're going to try to time, buy when valuations are low. On the other hand, what people do is they watch prices go up. Now it seems safe to them. They buy when valuations are high and expected returns are low. Buying when expected returns are low and selling when they're high is obviously irrational, yet that's what the vast majority of investors do. That's why you need a plan. You need to learn to act like a postage stamp and stick to it, simply rebalancing, which forces you to buy low and sell high.
Douglas Borthwick, as Larry was saying, when there's so much negative news about a particular topic or a particular investment, that's not maybe the time to shed the investment. That may be the time to embrace it. Now, certainly there's been
accumulate, yeah.
Right. There's enough negative information about what's going on in Europe right now. Do you see that there is any institutional appetite for European assets?
Well, there is, and it's interesting. There's a huge spread right now between the positioning on the IMM and actually where the interbank's trading.
Tell people what IMM is.
It's the futures.
The futures
market.
The
futures market right now is very, very short euros, 6 times where it was at the start of 2011. It's very extreme short. At the same time, though, the basis swap, which is how people essentially look at each other's risk, so how a U.S. bank would look at a European bank's risk, has almost halved across the curve. And what that means is we're looking at levels now of confidence from bank to bank perspective that were seen back in July before really the blow-up happened in November. But the euro hasn't come back. It hasn't really moved back much at all. Back then, when the basis swaps are where they are now, and when the 25 delta risk reversals are where they are now.
That's too complicated for me. Help
the price
me.
of puts relative to the price of calls.
I mean, that's basically the price of insurance, right?
That's
People
right.
making bets that maybe
the
things will go
price of insurance has halved
down
over the past month and a half. So it's halved in terms of short positions in the euro, and yet the euro still remains around this level with a very, very large short position. And our view is if the banks now believe that it's safe to trade with each other, and no one's really buying the puts anymore, in fact, they're buying calls, and that's why you've had this collapse of this risk reversal, then that means there has to be a pullback in the euro. And the last time we were at these levels in either the basis swap or the risk reversal, the euro was trading between 140 and 145. So yes, we see accumulation around these levels as opposed to selling.
That could be a violent move. Michael Purves, the idea that banks in Europe, more confidence there, and as Douglas describes, there's a big short position in the euro. Does that mean that we get almost like a big snapback? Because if you've got to cover your short position and admit that you're wrong, that could force the euro much higher against the dollar.
Well, absolutely. I mean, Doug's spot on about the, you have to watch the whiplash on the shorts. It happened the other day with some of the key steel names where you had big short positions. I think one of the things that's on my radar over the next several weeks and months is really are the U.S. equities going to be traded, sold in exchange for European equities. If those conditions keep improving, at some point there's going to be almost a replay of what we saw for the last few months here in the U.S. with equities.
Larry Swedroe, how does an investor steel themselves from these big swings? Because, if you come in one day and you see that the market is either up, 1, 2, 3% or down 3, 4%, you could be forgiven if you make a judgment based on that because you're emotionally driven.
I wouldn't forgive you.
Well, that's because you wrote the book. But right. how do you step away from it physically? What do you do?
There's only one way, I believe. First of all, you have to educate yourself and understand that markets are extremely volatile, far more volatile than most people believe. It's nothing like a standard bell curve. Okay, so that's number one. I think the only way most people can steel themselves is to actually sit down and write a plan. Now, no one would start a business without a business plan, but most people invest without investment plans.
Write it down.
Write it down. Your asset allocation specifically, how much they're going to have in gold, commodities, stocks, bonds, small cap, emerging markets, and then put a band around each one. If you want 5% in gold, say 4 and 6 are your minimum and maximum. And then every once in a while, check to rebalance and just do it. And the hard part is most people can stick with a plan when it's going well. The hard part is to buy when everybody else is panicked. So that's what makes Buffett and others good investors.
I want to thank you all very much. Larry Swedroe from Buckingham Asset Management, Michael Purves from BGC Financial, and Douglas Borthwick from Faros Trading. Thanks all very much for your insights.